Let's get a check on the oil markets this morning. Right now, it looks like crude oil is down by about 8 cents. For the week, it's down by 2.75%, $83.06 a barrel. But for the year to date, it's still up by about 16%. Joining us right now is Helima Croft. She is the global head of commodity strategy at RBC Capital Markets. And Helima, there's so much to talk about, things that are impacting the global energy markets. Maybe we start, though, with the foreign aid bill that the House passed over the weekend, because that has major implications, not just for the Middle East, but for Ukraine and Russia as well.
No, I think it's a very significant bill. I mean, two things we're watching. We've seen this increase in attacks on Russian energy infrastructure by Ukraine since the start of the year. The position of the Ukrainians was, if we don't get money, if we don't get weapons for the West, we're going to defund the Russian energy ATM. The White House not happy about that. So the question is, with this aid going to Ukraine now, will Ukraine essentially say, okay, White House, we will cease our attacks on Russian energy? So we're watching that. Second issue, Iran sanctions. This bill significantly increases sanctions on Iran. It increases the enforcement mechanisms, calling the White House to actually have to implement sanctions. And it also, for the first time, penalizes ports that take Iranian crude shipments. So the question is the White House going to go forward if this bill passes as expected and actually have to start taking Iranian volumes off the market?
Helima, let's just back this up a bit. I know we have talked about this in the past, about how the White House was trying to push Ukrainians not to attack those Russian oil installations because the White House doesn't want to see oil prices go higher. That's a difficult thing to face in any environment, but particularly in an election year. The same story has held true with Iran. They have not played more hardball because they didn't want to see Iranian oil not get shipped out for the global market.
I mean, this has been a limiting factor on U.S. foreign policy in both these instances. In the case of Russia, we have essentially allowed Russian oil to stay on the market. That's what price caps was designed to do, to enable Russian barrels to flow to Asia. Same thing with Iran. Iranian exports are now at a 5-year high. And so the question is, I think, particularly on Iran, with Congress now saying to the White House, we want to see a significant reduction in Iranian crude exports because what this money is funding in the Middle East. Will the White House go along with this, or will it basically say we have a waiver, 180 days, we're not going to implement this because we're concerned about tightness in the oil market? So it's going to be a tough choice for the White House come summer.
So combine that with the attacks that we saw from Iran launching for the first time, direct attacks on Israel last week. Where do you think that puts oil prices, let's say in the next 6 months or so?
I mean, the interesting question is, are we done? Essentially, is this latest dust-up between Iran and Israel the peak of tensions in the Middle East, or is more potentially going to come? I think for now, both Israel and Iran have signaled they do not want a direct war at this stage. The Iranians are happy to fight it through proxies. That does not mean the Middle East is in any way going through a more benign period. But for now, oil market participants are saying, we're going to focus on other issues. We're going to focus on the fundamentals. That still means, though, we have support for oil prices around this level. The question is, as we get into summer, as we get into peak driving demand, is it going to be a situation where we're back above 90 for Brent, $4 a gallon plus for retail gasoline prices? And does this administration go back to the SPR they've already signaled to try to bring prices down?